The fall of debt domino effect is starting. U.S. is on the cusp of a 2x prolonged period of typical recession. Now an interest rate that is high enough to deal with inflation, but it is too high of an interest rate for the debtor. And the dominoes are falling in a very classic way. Ray Dalio believes that the dominoes are beginning to fall in the financial markets and agrees with Jamie Dimon that a significant economic event is reaching its tipping point 9 months into 2023. Why recession is going to be twice as long as a typical recession this time round. Why you should not prepare for a new bull cycle just yet. How the fall of debt domino effect is going to affect the stock and bond market. What's Ray Dalio and Jamie Dimon's predictions for 2023? What it all means for the average investors today. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do, and push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? This year, rather than economic conditions improving, which is what the market seems to currently believe, we are about to enter what he calls a prolonged period of recession. If you don't already know, Ray Dalio is a wildly successful investor with a net worth of $19 billion. Bridgewater was founded by Dalio in 1975, where he operated out of his apartment as a wealth advisory firm, providing his clients insights on currency and interest rates fluctuations. Today, Bridgewater Associates has $235 billion of assets under management, making it the largest hedge fund in the world. Ray Dalio is one of the very few people that I look to for commentary on macroeconomics. Dalio just sat down and explained his stock market predictions for 2023. And his outlook for the next few months is pretty concerning. Dalio has spent decades learning about the economic cycles, going back hundreds of years. And while stocks and other assets do get pushed up and down in the short term, based on a huge number of unknowable factors, the broad trends of how the economic machine works are important to understand as they happen over and over again across time. One of these broad economic cycles is debt domino effect that Dalio sees playing out in many parts of the world at the moment. The basic mechanic at play here is the relationship between the bond market and government spending. Government all around the world generate revenue through taxation and investments. And they also spend money on things like healthcare, defense, and other programs. If government spending is outpacing the revenue they collect, then the government has what's called the budget deficit and has to be made up by the government issuing debt securities known as bonds. And the problem at the moment is that many governments in different countries around the world are currently having a very difficult time finding enough buyers for these bonds. If you take the UK, for example, inflation last year surged to as high as 11%, and it currently still remains above 10%, with no real signs of declining in a meaningful way. At the same time, the Bank of England, the UK's central bank, has set their official interest rate at just 3.5%. Or in other words, the interest payments that people would receive on those bonds if they purchased them from the government would be nowhere near enough to cover the amount of loss of purchasing power that the pound is losing through inflation. And when this happens, it can be very difficult for governments to find buyers to accept a negative real return on those bonds. And this means it's difficult for them to fund their budget deficits. Of course, the long-term solution here is that the central bank raises their interest rate enough that it brings inflation under control, or tries to solve the real supply chain problem head on, so that it increases the real return that investors get on bonds. But there is a problem that happens in the short term. As interest rates rise, the government's debt payment rises too. So either the government revenue needs to increase, or spending needs to slow to make up the difference. What you see in these periods of high inflation, when central banks ease more slowly into the recession, is they last longer and the drawdowns in assets are longer. So we would expect kind of a double the normal length of recession, because the Fed's not going to be at your back for a long time. And that's a big deal. The real issue for the world is Russia. War, Ukraine, energy, trade, and that is serious. And that's still out there. Hopefully, it will mitigate and go away, but it may not, he said. The only thing that matters for the future of the world is how this thing plays out. As for signs of bullishness, investors have been showing since the start of the year. Dimon isn't convinced a lasting rally is here. Markets have always been wrong, Dimon warned. Just look at the chart of S&P 500 market has been wrong for 4 times now. They just can't cross that trend line. Dimon previously forecasted a mild recession to hit the US this year and stocks to drop 20%, though he said his team was preparing for a more severe downturn. He thought that the Fed would likely need to continue its aggressive policy to sufficiently rein in inflation, predicting interest rates would push past 6%, which I think that's too much. If the interest rate is not peaked yet, what would happen to the bonds like TLT? It will probably drop back to retest the low. We're talking about a market meltdown. If interest rates have yet to peak, and that means more pain for the markets. Such a meltdown could even escalate what he says is a new world war that's already begun. World War III could have kicked off last year with Russia's invasion of Ukraine, with fears building that the conflict could expand this year amid bouts of economic turmoil worldwide. The only thing that's keeping markets up are interest rates. They go high and the market goes down. When all else fails, they take you to war. We're forecasting a market meltdown if they do what they say they're going to do, which is raise it to 5.1% and keep it there. Because market behavior has clearly changed this week. What just some weeks ago would have seen markets cheering the weaker data, as it would have suggested currently that the Fed's aggressive rate hike campaign is doing its job in tamping down the demand side of the economy, is now being judged more harshly, with bad news no longer enjoying a warm welcome by traders and investors alike. Investors are turning their attention to the health of the broader economy as cracks start to form. Retail sales fell 1% in December, and the revised November data also showed a 1% decline. It's the first real sign that the consumer is growing more cautious, as they hear over and over again that a recession is imminent. Business activity also slowed according to the Producer Price Index, and investors aren't happy. The S&P 500 has dropped more than 2% after the December retail sales data was released. None of this is a surprise to the bond market, as 91% yield curve fully inverted are telling investors that a 2 times longer than typical recession may indeed be coming. And no one is expecting it except for you. And this is a collaboration book with all my amazing clients. Adversity Equals Success. It's already yours. And my book, Rainbow Focus. You are such a good boy for watching my video right till the end. Bye.